So you can see my screen, right?
Yep.
All right. So I'm just going to kind of fly through this, right? This was a little bit focused on reverse simplified because the majority of brokers at this show had never done a reverse before. So I'm just going to fly through some of the important stuff. I mean, this stuff is probably information you already know, right? Seniors over the age of 62 control more than $12 trillion in equity. I mean, there is a ton of equity out there that seniors are sitting on. And in our current market, our current um, economy, seniors have no money, and the only thing they have may be their equity. I always find this one interesting that 43% of all home purchases across the United States are completed by those who are 58 years or older. So
Now, Pete, when you say 62, but how about 55?
uh, it's so that number would be even higher. I don't have that number in front of me. This is all stuff that was pulled out of, like senior like the National
No, but
Council of
but
Aging and that kind of stuff.
can those who are 55, can they do the loan
On a
in your?
proprietary, yes, heck 'em no.
Okay, that's what it is.
Yeah,
Okay, just for everyone to understand that's the difference.
yeah.
Okay.
Um, and I don't have any specific dollar amounts listed on the slide, but most of your baby boomers and those who are, in their, mid to late 60s have very little, if any, retirement savings at all. And what some of them have is like less than $50,000. We all know that's not going to last anywhere near enough time to retire on, right? So the myths of the loan, right? I mean, again, this is probably all stuff you guys already know, so I'm not going to spend a lot of time on it. One of the biggest myths is that the bank gets your home. People still believe this, that, take out a reverse mortgage and you don't own your home anymore, which is not the case. That it's a loan of last resort, which, there are instances where, we pull people out of foreclosure, right? And I actually have a scenario on that. But that's not all of them, right? So many times, like Gary, your situation, we're just doing it from a cash flow perspective, right? Free up that mortgage payment every month so they don't have to make it anymore. Silver divorces, home care, those are all reasons you should be looking at doing reverses, you know, time and time again. And this is starting to change a little bit, but all the heirs who are worried about their inheritance, right, with the reverse mortgage, or they're going to get stuck with this massive bill, you know, again, these are non-recourse loans. Heirs have protections where even if mom and dad were underwater on the property, right? So they owe more than the house is worth. If there's a reverse mortgage on it, the heirs are only responsible for 95% um, of the current value, if in fact they wanted to own it. If it was completely underwater and nobody wanted the house, they could just hand the keys back to the bank. Um, I hear this a lot still, is that they're going to outlive a HECM and have to pay it back. Well, I've yet to meet anyone who's past 150 years old, so I've never seen anyone outlive a HECM. And that HECMs are expensive, right? We get this a lot, that HECMs are expensive. Well, find me a product that's cheaper, that does no monthly payments, right? Mortgage or tax insurance, is non-recourse, it's government insured, has a line of credit growth feature in it, right? My response to that is there is nothing else like a reverse mortgage. So to say it's too expensive, yeah, it's not a fair story. That's like saying that a Mercedes is too expensive and you're comparing it to a Kia, right? I mean, they're two different things, right? They're not the same. So a little bit about eligibility, like Manny, you asked, right? On a HECM, borrows must be 62. On a proprietary, you can be 55. Um, I'm just going to kind of blow through this because of time here. I think this number is actually higher. I think the we probably do closer to 95, 96% of all loans are ARMs. In the past year, probably past year and a half, I've closed all of one fixed rate HECM. So the majority of what we do are ARM loans. You have many different payment options on the ARM, right? Fixed rate, and here's why we don't do many. Fixed rate is a lump sum cash at closing, one shot deal. That's it, right? They do not get a line of credit. They do not get a monthly payment if they option for that. There's different types of monthly payments in there. There's line of credit growth. on the arm. There's so many features on the arm that outweigh the fix. It just makes total sense. So just kind of talking about some scenarios which everyone tends to like, right? So these I have three scenarios in here, all of which were true loans that I've done in the past few months, right? So this first one was Bill. He was 75 years old. He had a $600,000 house in California, and he still had a $100,000 mortgage on the property. So he wanted to get rid of that mortgage, free up that cash flow on a monthly basis, and just have some future income or a line of credit. So we set it up as a few different options, right? So you see these are the same exact three products across the board, right? I just showed them all at the same exact margin, right? $600,000 property right here. And basically based on his age of 75, he was eligible for approximately $255,000, right? So you've got the mortgage insurance premium, you got the origination fee, which is paid to you guys, and you have estimated closing costs in there. And down here was the $100,000 payoff. So that left him 134,000 and change, right? So three options we were able to do for him. First was just a straight line of credit, right? So he could leave all the money there as a line of credit and just be able to draw it as he needs, right? He had access to a total of 134, $32,000 in the first 12 months, right? The other option was moving that instead of a line of credit, taking a monthly 10-year payment. So this is a monthly payment he's going to receive for as long as he lives in the property. He could literally live to 150 years old, and that money will still be coming into him every single month. So it is not based on future value or anything like that. That money is guaranteed for as long as he lives in that house. The third option, which is the option he ended up taking, was $10,000 cash at closing. He wanted $500 a month as a 10-year payment, and it still left him a line of credit of 52,000. So he kind of combined the best of all worlds there by mixing those all up. So he was able to get 10 grand to pay off some bills that he wanted to do. We were paying off his mortgage as it was, so that freed up cash flow. So he only needed about $500 more a month to make sure he was comfortable. And he had that fallback of $52,000 line of credit, which is going to grow over time. It's going to increase, the unused portion of that is going to increase.